Hi everyone, welcome to my channel. So today we are continuing CFA Level 2 Economics Chapter 1. In this video, we are going to study the concept of mark-to-market value of forward contracts. What is mark-to-market value of forward contract? I'll take an example. Imagine that you have entered into a forward contract, a 6-month forward contract. After 3 months, you want to exit the position, you want to close the position. Now, what would be the profit or loss at which you would be closing the position, or what would be the value of the contract when you're closing the position? That is known as mark to market value. If I write it in terms of words, MTM, mark to market value, MTM of a forward contract, it is MTM of a forward contract, it reflects the profit or loss, the profit or loss that would be realized from closing out a position at current market price. From closing out a position at current market price. If you entered into a 6-month forward contract and want to close out the position after 3 months, what would be the price at which you would be closing out the position? Have you made a profit or loss? What is the mark to market value of that position? So that is what is known as MTM, closing out a position at current market price. Before we, it is easy to understand this concept with the help of an example. But before starting with the example, there are some points we should remember. Points to remember. So this is usually a recap of what we studied in CFA Level 1. You don't need to revisit. I'll cover it in this video itself. The first point is, when a forward contract is initiated, the mark-to-market value of the contract is 0. So when a forward contract is initiated, the mark initiated, the MTM value of the contract is equal to 0. That is, when the forward contract is created, that at the time when the forward contract is created, at that time the MTM value of the forward contract would be equal to 0. Why is that? Because when a forward contract is created, at that time both the buyer and the seller wish to make a profit. So if the buyer is when the buyer is entering the contract, buyer wants to profit from the contract. When the seller is entering the contract, similarly, seller also wants to profit from the contract. So at the start, when the contract is initiated, at that time the MTM value of the contract is 0. Later on, when later on, as the spot price changes, as the market value, interest rates, etc. change, based on that, either of the party would make a profit, like either the buyer would make a profit or seller would make a profit. But when the contract is initiated, at that time the MTM value of the contract is 0. So that is the first point. Okay. Now the second point would be, once the contract is initiated, the MTM value changes based on the changes MTM value changes based on the exchange spot rate, based on the change in one, the exchange spot rate, because as the market value would be changing, the MTM value would also be changing. That's how either of the party would be profiting, right? And since we are dealing with currencies, foreign exchange market, interest rate also play a part. So as the market reference rate changes, the MTM value would change. So once the contract is initiated, the MTM value changes based on the change in the exchange rate and interest rate. Now the third point is, it would be something we would be understanding based on the example that would be explained after this point. So once we enter into a contract, after that when we want to close out the position, in that case, to close out the position, to close out a forward position, how can we close out a forward position? To close out a forward position, we have to enter an opposite contract. So if you have entered a 6-month long forward contract, to close out the position, you will have to enter a short forward contract with the same maturity. To close out a forward position, we must offset the position with an equal and opposite forward position. Don't worry, we would be explaining this concept in the next. After writing down this, I would be explaining the concept with the help of an example. Offset with an equal and opposite forward position using the available. Now when you are entering the offset position, at that point you would be using the spot price, available spot price. You can't go back and enter in a different spot price, right? You have to enter, even if it is a loss or a profit, you have to enter at the price. You would be offsetting it at the spot market price. So spot price available in the market when the offsetting position is created. The third point explains that if you have a forward position, to close out the position, you will have to enter an offsetting position, and the offsetting position has to be an equal and opposite contract. So if you have entered into a 3-month long contract, you will have 1 million 3-month long contract, you will have to enter a euro 1 million short contract. Now we can understand this with the help of an example. In this question, they have said that Ria is a market participant who bought GBP 1 million forward for delivery against AUD in 9 months at an all-in forward rate of AUD to GBP is equal to 1.9100. So in this case, they have said that Ria is a market participant who entered into a 1 million GBP forward for delivery against AUD. In this case, it is a long position in GBP. Like Ria has bought 1 million GBP and she would be paying AUD for buying GBP. And this is a 9-month forward contract at an all-in forward rate of AUD to GBP is equal to 1.9100. What does all-in mean? In this case, all-in means that this 9-month forward rate is already this 1.9100 is the 9-month forward rate. That is, it is the spot rate plus scaled forward point. You don't have to calculate separately, it is already calculated for you. That's what it means by all in. So in this case, AUD to GBP is equal to 1.9100 means 1 GBP is equal to 1.9100. That's the price at which Ria has agreed to buy GBP after 9 months. That is the 9-month forward contract. Now, in the question, they have said that 6 months later, she wants to close her position. The market data now is AUD to GBP spot rate is given as 1.9210 to 1.9215 bid and offer, and the 3-month forward point is 130 and 140 bid offer. 3-month AUD MRR is given to be 2.4% annualized. Calculate the MTM value of closing position. Okay, so now in this question, they have asked us to calculate the MTM value of this 9-month forward contract, which Ria wants to close after 6 months. How will we calculate the MTM value? So let us start by solving. I'll write down the concept first, like what is explained in the question. So in this case, first thing that is mentioned is that Ria bought 1 million GBP. Ria bought 1 million GBP at a forward price equal to at a forward price where 1 GBP equal to 1.9100 AUD. Okay, and when would this settle? This would settle, it is a 9-month forward contract. 9-month forward, that is, it will settle after 9 months. Ria will be buying it at a price, at this price after 9 months. Settle after 9 months. Okay. Now the second section of the question said that 6 months later, Ria wants to close this position. So 6 months later, Ria wants to close this position. Ria wants to close this position. How can she close the position? close this position, to close the GBP long 9-month forward position, Ria will have to enter an offsetting position. Enter an offsetting position. That is an equal and opposite contract. To enter an offsetting contract. Okay. Now, the first thing I would be writing is her, like, how can we understand what should be the offsetting contract? So, in this case, to understand how to create the offsetting contract, I'll write the contract that she currently holds. So, currently, the contract Ria holds is 1 million GBP long forward contract, which would settle in 3 months. That would settle in 3 months. Why didn't I write 9-month forward contract? The reason behind that is it has already been 6 months after the contract was initiated. So now only 3 months is left for the contract to settle. In this case, when I'm entering the offsetting position, I shouldn't look at the contract as a whole. Instead, I have to look at it based on the settlement date. Hence, I'm only looking at the duration left for the contract to settle, that is 3 months. Now, the offsetting contract would be opposite of the contract that she currently holds. So, offsetting position would be opposite of this one. Offsetting position, offsetting contract would be equal to 1 million GBP. Ria holds a long forward contract, hence the offsetting contract would be 1 million GBP short forward contract. That is, Ria would be selling 1 million GBP to close the position. And for how many months should she enter the forward contract? It should be a 3-month forward, because the above contract, the contract Ria already possess, will settle in 3 months. Hence, Ria will have to enter a 3-month forward contract. It will be a 3-month forward contract. 3-month forward contract. That is the offsetting position contract. Okay. Now, in this case, Ria will have to sell 1 million GBP. That is the offsetting contract. So how can she sell 1 million GBP? At what price will she be able to sell 1 million GBP? For that, we'll have to go back to the question. So here they have mentioned that 6 months later, Ria wants to close her position. The market data now is AUD to GBP spot rate is given, and the 3-month forward rate is also given. Forward points are also given. To sell 1 GBP, if Ria is selling GBP, dealer would be buying GBP. In this case, since Ria is selling and dealer is buying, we would be using the bid price. And we have to calculate the 3-month forward for the contract that we are entering. Hence, the forward point should also be considered. So, the forward point is 130. So, if I write it down, the 3-month forward bid price, the 3-month forward bid price, that is the price at which RIA would be able to sell 1 million GBP in the 3-month forward contract, it is 1.9210, that is the spot bid price, plus 3-month forward points. I have to convert it into decimal points from PIP, percentage in point. So that's why I divide by 10,000. It will give me 1.9340. Now this value means that at the beginning, for the first contract, that is 9-month forward contract, RIA bought each GBP for RIA in the beginning. For the first contract, RIA bought each GBP for 1.9100 AUD. Now, in the offsetting contract, RIA is selling each GBP for 1.9340 AUD. Both of these would settle after 3 months because 6 months have already passed. Both of these contracts will settle after 3 months. So after 3 months, the profit or loss that RIA would make is equal to RIA bought it for 1 GBP is equal to 1.9100 AUD and sold it for 1 GBP is equal to 1.9340 AUD. So RIA sold it at a higher price, hence RIA made a profit. And what is the amount of profit that RIA made? It will be equal to the difference multiplied by the total amount that RIA invested, which would be equal to AUD 24,000. Because 1 million is the amount RIA invested, and this is the difference between the investment durations. Hence, RIA made a profit of AUD 24,000. Now, this AUD 24,000 is an amount that would be received after 3 months because this is based on the 3-month forward rate, right? But I need to close out the position. That is, RIA needs to close out the position today. That is 3 months, like after 6 months of the first contract. Hence, in this case, RIA has to discount this amount by 3 months. How can she discount this amount? So this AUD 24,000, it is to receive after 3 months. After 3 months, right? But RIA needs to close the position today. Hence, to get MTM value, that is the present value, to get MTM value, RIA will have to discount the AUD profit, discount AUD profit, because this amount AUD profit is provided, this profit is in terms of AUD. To discount it by 3 months, you need to use AUD MRR. Discount AUD profit at 3-month AUD MRR, and that would be equal to 24,000 AUD divided by 1 plus what was the MRR provided? The 3-month AUD MRR is equal to 2.4% annualized. So since it is annualized, I have to discount it to 3 months. 2.4% would be equal to 0.024. that is 2.4 divided by 100, and it is an annualized amount. Hence, I have to convert it to 3 months amount because I only need to discount it by 3 months. That is 90 by 360, and this would be equal to AUD 23,856.86. The profit that Ria made is equal to AUD 23,856.86 if she closes her position after 6 months. For the 9-month forward contract that she had entered, she will get a profit of 23,856.86 AUD, and that is the MTM value. With this, we solve this problem. Hence, to summarize, how did we solve this problem? To summarize, to get the MTM value, to calculate MTM value, there are actually 4 steps involved. To calculate MTM value, there are actually 4 steps involved, and the steps where we actually solved it, I'm just summarizing it. The first step, if you have to calculate MTM value for forward contract, for forward position, first you have to enter an offsetting position. Create an offsetting position for the contract you want to calculate the MTM value. Second point is, once you have created the offsetting position, you should determine the appropriate all-in forward rate. Determine the all-in forward rate, forward price for the offsetting position. For the offsetting position. The next step, once you have entered an offsetting position, calculated the forward rate for the offsetting position, the third step is to calculate the settlement amount on the settlement date for the forward contracts. So, calculate the settlement amount, that is cash flow, as on the contract settlement date, the specified settlement date in the contract, that is the actual maturity. Now, once you have calculated that, then you have to discount it to the date on which you are closing the position or offsetting the, or you wish to get the MTM value. The date on which you want to get the MTM value or you want to close the position, to get that value, you have to discount the cash flow. So the fourth step is to calculate the present value. Calculate the present value, that is mark to market value by discounting the settlement amount, the settlement date amount, date cash amount to present date to present date. So this is how we calculate the offsetting position for a forward contract. Now we have reached the concluding part of this video. The concluding part is, what are the factors that affect the bid offer spread for forward points? Factors that affect bid offer spread for forward point. Actually, the factors are same as the factors that affect bid offer spread in the case of spot market. So it is same as factors that affect bid of spot market bid offers of spread factors. Uh, if I summarize, or if I give a quick recap of the previous video, what are the factors that affect bid offer spread in the case of spot market? It is interbank market liquidity. Higher the liquidity, less thinner is the spread. Lower the liquidity, wider the spread. So interbank market liquidity is a factor that affect bid offer spread. The second factor would be currency pair involved. Currency pairs that have high volume trading, they have thinner bid offer spread. If it is not having that much volume of trading, then it will have wider bid offer spread. Then again, size of the transaction also matters. So for very high value transaction as well as retail transaction, bid offer spread would be wider. And another point is dealer client relation. Dealer client relation, that is, if the dealer wants more business, repeat business, dealer might provide thinner spread quote for institutional clients, etc. Hence, like to get more business, they might provide thinner spread. Whereas if it is like to normal retail customers, they might quote a wider spread, bid offer spread. Now, in the case of forward contract, there is one additional point that affects bid offer spread. In the case of forward contracts, for forward contracts, the duration of the contract also affects the bid offer spread. The duration of the contract, that is, longer the duration, wider the spread. Longer the duration or longer the term of forward contract, wider the spread. Wider the bid offer spread. Why is that? The reason is because liquidity is less in forward contracts, forward market compared to spot market. The reason is, first, liquidity is lower in liquidity is lower in forward market compared to spot market. The second reason is counterparty credit risk increases. Counterparty credit risk increases. And the third point is interest rate risk also increases. Interest rate risk, because MRR can change. Interest rate risk, if the duration is longer, interest rate risk increases. That's why if the duration is longer for forward contracts, the bid offer spread would be wider. That's all for today's video. If you like the video, please do subscribe to my channel. Thank you.